Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is Mark Berg. He is the co-author of A Matter of Time, Principles, Myths, and Methods for the Hourly Financial Advisor. He's also the founding principal of Timothy Financial Counsel. So welcome to the podcast, Mark.
Thank you, Bob.
Pleasure to have you here. Before we get going, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview of your CV?
Sure. I got into financial planning in 1995, so it's been about 27 years now, close to 28, and I've always been in what would be considered the traditional fee-only financial planning. I was with a large RIA for the first 6 years, and then started Timothy Financial back in the end of 2000. So we are now in our 22nd year, and we do hourly only, fee only financial planning.
Great. I should mention part of our discussion today is about a book that you recently wrote, which I guess provides recipes for how people can hourly planners. So first of all, the book is called A Matter of Time, Principles, Myths, and Methods for the Hourly Financial Advisor.
Correct.
So we're eager to learn more about this book. What's in it, and what advice do you have for folks who perhaps have been thinking about hourly but don't know how to go about it?
Yeah, well, Matthew Jackson, my co-author, and he was actually the one that really prompted the writing of this book. I wouldn't say writing was ever on my bucket list. He agreed to do the bulk of the actual writing, and I was doing most of the content from my experience. And it really did become a labor of love, because I realized how much has changed over 22 years. And you'll note in the book, we started with right out of the gate with the myths versus reality. And that was, I would say, for anyone who's considering hourly, that's probably the most important thing to read, because there are a lot of myths out there as it relates to hourly financial planning, all of which, as you would see if you read the book, are, from my vantage point, not true and easily really pushed aside, but they're necessary. It's very necessary from my vantage point to really work through those myths, make sure that you are starting with really a clean slate as it relates to that before you enter into planning, because it really can hinder or cause you to go in directions that really aren't healthy long-term for either the business or for the client.
Yeah.
So, but then from there.
Well, before you go on, let me just stop you for a second. Obviously, I have my thoughts about what some of those myths might be, but perhaps you could share what the top 2 or 3 myths are that people have about hourly financial planning.
Wow. I have 12 different myths listed in there, and that was actually a pared down list. But yeah, a couple of that I would maybe start with. One is, I think hourly is often considered just for more of the middle market. And so, the wirehouses, the RIAs, the ones that work with, the well-to-do, the mass affluent, the high net worth, ultra high net worth. And that was one of the myths that I bought into when I started Timothy Financial. I assumed it would be more serving middle income, maybe some mass affluent. And what I found, not because of my marketing, but because of who called us, was actually not the case at all. The people that were calling us were people that were financially very well off, some to a substantial degree. And we've seen, actually, as time has gone on, that more and more some pretty substantial circumstances have come our way, and we've been able to serve them, and we enjoy serving them. I wouldn't say that's our target. Really, our overall target is just to do hourly planning. And we were able to serve quite a wide swath of clients because that model allows you to, because it's not dictated on, do you have enough assets or enough income or at a certain stage of life. So that's one of the myths that I think is very important for people to break early on for setting out in this venture. Another one that I think is a common belief, which is not fact, is that people don't like paying by the hour, that they would prefer other fee methodologies. And again, we've been doing it for 22 years. We just hired our 17th person. We are actually have a wait list over a year long of people that are looking for our services and growing. And our clients are 2/3 to 3/4 of our revenues are from clients that we've served in the past. So we, just like I think any profession, value relationship, value that ongoing relationship, and our clients are no different. And when you look at professions, you look at practice of law, you look at CPAs, you look at psychologists, all of them go by the hour. And so, and yet I've worked with my CPA for well over a decade, and we have a good relationship, and other professions as well. So I'm not sure why it was applied to financial planning, that it was going to be a transaction-based relationship, but that has not been the case for us.
All right. Well, maybe I'll ask you about this because it's on my mind, which is when I think about planners charging hourly, you think about the number of hours it takes to create a plan or an investment policy statement or retirement income plan, whatever it might be. And if you're dealing with a client with $1 million and you're charging them 1% of assets under management, maybe you can ballpark the fact that of that 10,000, you'll spend 33 hours working on the plan. But obviously, you need to generate a profit. And if it takes more than 33 hours, you'll have to go back and say to the client, well, it's $15,000 or whatever X per hour it is going to take me to do this plan because of the complexities of it. You have, I don't know, ISOs and deferred comp or non-qualified, et cetera. So to talk a little bit, I guess, about the business of creating an hourly plan relative to, an AUM model.
Yeah, I try not to pick fights with other fee models because we are very much the David and they're very much the Goliath. So I'll largely stick to kind of the way we do it. When somebody reaches out to us, we typically give them a free initial consultation. That's just an opportunity to get to know their circumstance, their goals. They provide us information in advance because we do this all the time. I mean, this is our business, is doing planning for clients. It actually is not that difficult to get a sense of what the time might be. And, you started the whole conversation with, it's going to take a certain amount of time to do a certain, we'll just say project or work. And the reality is we track our time. We track all of our time every day. Very easy to do. Technology has definitely helped us with that. What I find ironic is, and we feel it's actually highly valuable in our business planning and projecting and planning for the future. But most people in financial planning don't track their time. And I think that is a big miss on their part, whether they're AUM or retainer. There is one thing that all of us have in limited supply, and that's our time. And so because this is the way we do business, we're able, when they call us, even without seeing a lot of data, we're able to say, well, you're probably this level of complexity, and that would put you in this range because we have 5 levels of complexity. And then if that hasn't scared them off, because that gives them a kind of a cost range, which for the most part, people are very, very receptive. We then set up that free initial consultation. We go over the data with them, and then we can give them a firm quote up front. So before they've committed, they know this is how much time it's going to take for us. And if it takes us longer than we expected, that's our problem, not theirs. So on that front end, that initial engagement, we do set a clear expectation. That is true on all of our clients except for what we call level 5 clients, which are very high complexity clients. I just presented one yesterday. CEO just had a kind of a private equity cash out. And there's a lot of tax issues, planning issues, investment issues. And for level 5s, we don't quote. But typically they're in a financial circumstance that they get that. They understand that, it's a moving target, and we just track our time and bill them monthly.
Right.
But then ongoing clients, we don't quote. We kind of set a general expectation, but we we just track our time and then bill at the end of the engagement. So that's a pretty typical way to how we work with our clients.
Yeah. Do you have a set hourly rate, or does that vary too, depending on the complexity?
Varies depending on the advisor, not the complexity. Now, obviously, there's a tie. The more complex client typically is working with a more senior advisor. So our firm hourly rate, so if they were to work with kind of the majority of our financial planners, they would be charged $350 an hour. That's kind of our set rate. But then some of our partners are billing at different rates, $450 an hour for a more senior. I'm at the highest, largely because I'm not, well, one, because I've been doing this a long time and I work with the most complex clients. But two, I'm actually not looking for any more work. I've got a very full plate. And so my hourly rate is partly also to dissuade people to hire from hiring me and to hire my colleagues. So my hourly rate is $800 an hour. And so you really have to want to work with me. And I feel like 99% of the people that call us are going to be very, very well served by our team. Right. So that's the way. So whoever is their lead advisor, that is the hourly rate for that engagement or for that service model. So people can pull me in to help in a collaborative way as we build out their plan or deal with issues, but they're not going to be paying my rate. They'll be paying that advisor's rate.
Right. And you mentioned that I think it was a relatively high percent of people retain you. I would imagine it's for annual reviews or life cycle events that have occurred, and that the other percent that don't continue on receive what they need for now.
Yeah, that's exactly true. I would say level 1 through 4 client complexity levels, we do once, maybe twice a year, where we're checking in on either cash flow issues, tax planning, investment recommendations, et cetera, maybe estate planning as not an annual review, but as a one-time review and conversation. Whereas level 5 are most complex. Those are very much ongoing. We're connecting with those clients on quite a regular basis. Just their complexity dictates it.
Yeah. And you'll forgive me for asking, just in terms of a gross range, does it go from 10,000 up to, I don't know, $100,000 per year?
I would say for an initial, probably the lowest amount of time to do our planning approach for an initial level 1 type of complexity would be maybe 10 to 12 hours. So you multiply that times our $350 an hour, and that would be kind of the lowest end. On the highest end, yeah, I've served a client at the beginning of this year where they had a huge liquidation event and had over $100 million and they were looking for a relationship manager, but they were still working. So he said, let's find somebody for you. So we helped them with that search process and did all the interviewing and all the vetting for them. And that was over $100,000 engagement. So again, the beauty of time is time. We can work with, 20 clients, or we can work with one client, and it all adds up. It can all add up to the same amount of time, and we're fine either way. So we don't have like a strong preference for working with level 5s versus level 1s. That's the beauty of hourly, is it gives us that flexibility to work with the whole spectrum of clientele.
Yeah. So in your book, lots of folks have maybe listened to folks like Bob Veras describe the benefits of moving from AUM to hourly or retainer. In your book, you talk about, in a way, the process for doing that. Maybe talk more about that.
Yeah, and really the purpose of the goal is not to say you should stop doing asset under management and you should do hourly or the retainer model. It's really, we believe, we at Timothy Financial and others that do hourly, I believe that over time, consumers are going to be more and more attracted to this. Not that the industry wants to go in the direction of hourly. I don't think that they do, for probably some obvious reasons, but I do think that there's going to be a higher and higher demand. We are already seeing that in spades and trying to grow to meet that need. But really the purpose of the book was definitely not to make money.
It never is. Yeah.
The amount of time, especially at my hourly rate, it takes to write a book, that'll never even get close to breaking even. But it was really seeing that there's a greater and greater demand. There's a huge gap in the overall industry for serving clients in this way. There are a number of people. In fact, to me, far larger than what is currently being served by the industry, that could be really well served in an hourly capacity that are not really being served by anyone. And so the purpose of this book is to help those who either are thinking about starting their own firm, and maybe they're at a different firm right now as an associate, maybe they're a partner, but they're thinking about striking on their own and doing things differently. And that was my case 22 years ago. And considering what's the model, what's the approach that I want to take, and with the goal of really giving them a blueprint and helping them learn from some of the mistakes and some of the successes that we've had at Timothy Financial in order to get a faster start than I did back in the day. So that's really the objective. I would say for those who are currently assets under management, it is a massive change. It is complete mindset change from traditional asset management firm or even a retainer firm to an hourly approach. And really, it changes everything across the board. And so unless you are very small, this should probably be too big of a hurdle to cross.
Yeah. Maybe talk about maybe someone who has an existing client base and how they would segment it, and then maybe how they would prospect for entirely new clients. It seems like part of this issue would be around positioning, right? Finding the clients who have expressed maybe interest in this or have expressed displeasure in the AUM model.
Well, everybody knows the common issues with asset under management range. Even if we look at the environment we're in today in the middle of 2022, a year ago, we couldn't get our clients on the phone because they're like, everything's good. What do we need to talk about? And that's kind of the oddity of an AUM fee model, is when you do the least amount of work, you're getting the most compensation. When you're doing the most work, which is now when clients are panicky and you're having to do a lot of communications, a lot of meetings, you're actually getting paid a lot less because your assets have declined. So to me, that's one of the beauty of the symmetry of hourly, is it rises and falls based on the needs of the client. So it's just really common sense. And I think that's what's been attractive to clients about this approach. Similarly, even when you look at the retainer model tends to be, and I've been in the retainer model pre-Timothy, and it tends to be a look back. You've done a year, you feel, often they're not tracking their time, they just feel like, wow, I spent a lot of time. And so you're like, okay, Mr. Client, remember I did all this work last time, and so we're going to adjust your fee accordingly. Well, last year doesn't mean it's going to be the same as this year. It could have been event driven, whatever. And it's, again, the symmetry of hourly, I think, is really helpful that way. So I'll pause there to see what direction you might want to go from there.
Yeah, in your case, you've 20 odd years of doing this, you've been able to position your practice, I think, in ways that other people that distinguish you. What advice would you have for someone who's going to embark on this hourly path and how they should position their practice?
One of the things, and I say this somewhere in the book, is once you choose your model, stick with it. It's especially in the early years of starting a practice. You'll work with anyone. You're just trying to kind of get things going. It does take time. It takes time to build a reputation and to build clientele. What I've seen is hourly practitioners that start hourly, but then they say, well, boy, that siren song of assets under management is very alluring, or I'd love to get that regularity of the retainer. But what it does is it creates confusion for the client. Are you asset management? Or you feel like you're doing the client a favor by offering a menu. We'll fit you wherever you want, but they're looking for clarity. They're looking for consistency. That would be kind of one of the main things that I would say is, once you determine whether it's hourly or not, once you determine this is what fits me and fits kind of the directionally where I want to go, stick with it. And that's what I did with hourly. Partly because as you're building network of either other financial advisors or attorneys or CPAs who you're building a relationship with, they're getting to know you, they're getting to know kind of your value proposition. They need to know who you are and how to explain your model and what you have to offer. And especially, we get a lot of referrals from other financial planners. And if all of a sudden we say, hey, we're taking assets now, that would they
Yeah.
would not be so happy with that. In fact, I would say the first 3 or 4 years of starting Timothy Financial, that's what I regularly heard back. You're just, you're going to do this a couple of years and then you're going to go to assets under management just like everybody else. Here we are 22 years later and still at it.
Yeah. So let me go back to this notion of pricing. Obviously, financial planning, investment management firms, they have all these fixed costs, compliance, operations, technology, et cetera, et cetera. And so when you think about making sure that your hourly rate covers perhaps the fixed expenses and generates a profit, fact that you have to track your time. I think Kitts has said at one point that maybe you've got 2,000 hours of billable hours or in any given year. Talk about the process of sort of establishing the pricing, given that you have all these costs in place.
Yeah, well, one of the benefits on the cost side is it's actually a lot simpler model than most financial planning firms because we're not, needing to buy rebalancing software. We're not needing to deal with a lot of those compliance issues that an asset management firm would have to deal with. And so it brings actually quite a bit of simplicity and quite quite a low cost structure to the way we do things, which I'm thrilled about because what I do is for our team is we look to add benefits like our 401k match and this and that to use those dollars more productively towards our team. That doesn't mean that we go cheap. I mean, we really invest in technology and we're willing to invest in anything that we feel will either assist in the productivity of how we do business or give the client a better overall experience. But frankly, I've been really, really pleased by how reasonable it is to run an hourly financial practice. So that's one thing I would say. As far as pricing is concerned, I had a conversation recently. It was funny. I was on a panel, and one of the panelists had done this panel before and had shared with us the slide presentation that they had used. And on the hourly model, she had put a note in the bottom. I think whoever was on the panel charged like $250 an hour, and she had put in the speaker notes like, how can they like possibly justify that hourly rate? And I kind of chuckled because I've heard that before. And so I asked her the question. I said, "Do you use an attorney?" And she goes, "Oh yeah, yeah." And I said, "Do they have like an associate?" Yeah. What do they charge an hour? Oh, like 283 something. And I said, "Do you think that financial planning is more or less valuable than hiring an attorney?" Oh, it's far more valuable.
Yeah.
And eventually she kind of like put the pieces together. Oh, okay.
Yeah.
And again, we don't get a lot of pushback on our hourly rate. I mean, of our prospects, our close rate is right around 90% of our prospects become clients. So I would say for somebody, especially if they have a CFP, have some experience in the financial planning arena, a very safe starter point is $300 an hour.
Mhm.
I wouldn't blink at that. If we followed Kits's perspective, 2,000 hours, that's not bad revenue, right? $600,000. But I would push back on the 2,000. You can do 2,000. You'd have a very unhealthy lifestyle. My brother's a lawyer, so I know that side of the equation. So I would say the billable time, if you look at a kind of a peak number, especially for a solo of maybe 1,200 hours, that's a more reasonable expectation because you need to do the marketing and the prospecting and paying the bills and sending invoices and things like that. So there's other work to do that needs to be accounted for. But like a law firm, as you grow, then you can leverage your time. You have other people doing some of those things that you were doing yourself, and that allows you to bill more. And I would say on a high end for me, who's definitely the most experienced, and I have enough work that I could fill all my time if I wanted to. About 1,400 is about as much. But at the same time, I probably take 6 weeks of vacation a year. I don't work weekends, so I'm pretty disciplined in keeping a reasonable life balance.
Right.
And so for people who want to work more, they can, and they can make more. I just choose not to.
Yeah. I didn't ask earlier about the deliverable. Is it a comprehensive financial plan with an investment policy statement, or is it more modular in terms of maybe it's education planning or insurance planning or income tax planning?
Yeah. So we offer comprehensive, and in fact, anytime we do planning and advising, we're doing it in a comprehensive fashion. So we're always factoring in, obviously, the cash, tax flow, estate issues. That's just the way we do business. But as it relates to the deliverable, like a lot of advisory firms, we often do things over time. It's most common that people hire us for the traditional cash flow retirement planning, which is really the core of what we have to offer, and the investment review. So those are the two most common that our initial clients hire us for, and that we keep updated on an ongoing basis. The software we use, so we don't give them a big book, print out a 150-page plan. Those days are way in the past. But we do provide them not only with our executive summary of all of our recommendations and a game plan, but also anything that we've, whether balance sheet, cash flow projections, investment recommendations, all that typically is given to them electronically as like you say, a deliverable. So that's the way we do it.
Yeah. As you're talking, Mark, I'm reminded that that Cheryl Garrett maybe perhaps blazed this trail many years ago, and to a degree, it's that trail's still being blazed, right? Decades later.
Yeah. Cheryl influenced me 22 years ago. That she was part of the prompt that got me into the hourly approach. I think, though, honestly, some of those myths that I went through were fairly prevalent back then. And to her defense, I mean, her goal in hourly, in kind of promoting hourly, was to serve the middle America.
Yep.
That was her target. So, some of her earlier conversations related to this being more of kind of almost like an add-on to a financial planning firm than it necessarily being everything. Yeah. And I honestly don't know how the message has evolved for the Garrett Planning Network, but I found that kind of more of that add-on perspective really didn't work for me. Mm-hmm. And so that's why I kind of have gone the direction that I've gone. And again, it's no regrets.
Yeah. You mentioned earlier this notion of developing a relationship-based approach rather than a transactional mindset, and I wonder, some planners who have an AUM model might not characterize their mindset as transactional. Is that fair to say?
Yeah, I doubt they would.
Yeah.
I think any financial planner is looking for relationship. I mean, that's part of the joy of what we do is really building deep relationships with our clients, and hourly is no different. And I think, again, this is one of the myths. People thinking, well, they're just looking at their watch the whole time as we're doing advice. But a common statement I make not to clients, because they're not the ones that are complaining, it's other advisors that are bringing up the question. What I say is, price is an issue in the absence of value.
I love that phrase.
So if we're not bringing value, then price is an issue, and they'll fire us. And that's, again, part of the beauty of hourly is we have to bring value every time that we are connecting with our clients. Yeah. They have to feel that value, just like in an attorney relationship, CPA relationship, psychologist relationship. You've got to bring value, because if you're not bringing value, they'll just stop calling.
Yeah.
And so, that's how I'd answer that question.
Yeah. So my old boss used to say that, by the way, that it's only in the absence of value. That
Yeah.
the other, which is great because it does make you think about, am I delivering value?
Yeah. Yeah.
Um, there was, you triggered another question in my mind, and now it's escaping me. I'm fond of saying, Mark, that if you had to build this profession from scratch, it would look nothing like it looks like it is today, right? That
Yeah.
it might be
Yeah.
more like physicians and lawyers and CPAs, both in terms of pricing and maybe even a regulatory environment. What if you had to build this from scratch? What would it look like?
Well, again, I think the challenge, even as I've sat on panels and had conversations about this, most people are presenting this from the vantage point of the business owner. So what can be the most profitable, leverageable, and I hear lifestyle practices. I go out kayak in the morning. I spend a couple hours, doing a few trades and making sure I keep up with my email. And then I go, surfing in the afternoon, and it's great because the revenues keep coming in. Well, that's from the business owner's perspective. I think for me, the question really has to be flipped to the consumer's perspective. What is the best way to serve the consumer? Is it through where financial planning really started, which is in the commission model, largely insurance related? Is that the best way? And then it evolved, and I'll say evolved, but some people might not agree with that. But I'll just say it transitioned from that into more of this assets under management. And then now it might move towards more of a retainer. Will it ever get to hourly? Who knows? But the practice of law has been around for 2,000 years, and they've been doing it hourly. CPAs have been around for 250 years. They do it hourly. All professions, the actual professions do it this way. And so I think it makes a ton of sense from the consumer's perspective.
Yeah.
And that's why I feel like it really aligns well. It doesn't mean that another way to do it is bad and hourly is good. But when you ask the question, how do I think it should be built? It should be built on how can we best serve the client in the most efficient fashion. And my very limited perspective is hourly is a great way to do it. And I think that's what it should be.
So it seems easy enough to implement at Timothy Financial and maybe very many other firms. How does a large brokerage firm implement this across 10,000 plus Series 7 brokers or duly registered?
Yeah, and I would say they largely don't
or can't.
Well, that's a question for people that get paid a whole lot more than I do. Yeah, I think that I got a call last year from somebody at a broker dealer local, and he heard about me, and he sells insurance products. He does AUM, and what I found out when he called was really the reason he was calling was he said, there are some times that I do some work for a client that they don't follow through, like buy my insurance product or whatever, and I'd like to charge for that. So they're basically just looking to fill the gaps of like anything that they aren't paid from this or that they got a kind of a third revenue stream. And I was like, boy, they just missed missed what I was trying to communicate altogether. So this goes back to our earlier conversation. You kind of have to pick your lane.
Yeah.
And hourly in the broker dealer model, I don't think it's possible, to be honest. It's such a different way of doing business, and I don't honestly see it. I'm just being honest.
Right.
I would love to see it. I would be surprised if it ever happened.
So it's largely in the RIA market then, and
even that, there's plenty of hurdles there. I mean, if you're already doing the percentage of assets under management, it's very It can be very, very lucrative. It can be, I think if people actually tracked how they spent their time, I think there would be some surprises there. The other thing that if we look at just the industry trends, well, what has happened? We've gone from active management to passive. There's been a really big push down in fees. So, mutual fund expense ratios, et cetera, have gone to almost nothing in some cases. And then we've also seen transaction fees go from something significant to none.
Right.
And so what's left? The consumer's looking for savings, and what's left? Well, the advisor fee. And 1%, especially if we're in a negative or in a lower return environment. I was interviewed by the Wall Street Journal last year on this very topic. What's going to happen if what the prognosticators say is going to happens, which is we're going into low mid-digit return environment. So let's say, just to kind of play that out, it's 5% average annual return, and you're taking 1% of that. Wow, that's 20% of the client's return. That's a pretty substantial piece. And we're already seeing with robos, but even other offerings, that they're starting to get some of that compression in fees. And so I just don't see it as sustainable. And really, to me, it bifurcates the commodity from the true value. Asset management, to me, fits more in the commodity side of the world, in that there are thousands of outstanding, excellent options out there for asset allocation, for money management, but it's the planning that really is the sticky. That's where the value proposition is with the client. And yet all the pricing is on the assets, the commodity, and none of the pricing is on the value, the planning. And so it's really going to require a complete flip of the existing way of doing business to see movement in this direction, which is why I think it's going to be a long time before we see that movement.
I too agree with you that the notion of placing the value on the investment management sort of then devalues the financial planning side of things, and which is where the value should be. But it's also interesting that there's been a good deal of research by people like David Blanchett and Vanguard that look at advisor gamma or alpha, depending on which study you look at, and talk about, well, these are the things that add value and it far in excess of the fee that's being charged on the AUM side.
Yes, and actually I would agree with that, because it talks a lot about kind of behavioral is the biggest piece of it. Well, but if you can get that same alpha in an hourly fashion, where you're helping people with the behavioral issue. In fact, I mentioned that earlier this year I was helping a client find a new wealth manager, and that same client, we had actually gone through that exercise 5 years ago. He had a much smaller amount, and so we invited back one of the presenters, and I looked at his presentation 5 or 6 years ago versus today, and that very study that you mentioned, the Vanguard study, they had used with here's all the values that we bring 6 years ago, and then I looked at it, what they had listed today, and it has shrunk considerably because a lot of things are now automated. So the value add that they were doing manually 6 years ago are now just kind of there. And so again, that's why I think there is reason to be concerned long term for an AUM based approach as to could there continue to be fee compression from a revenue standpoint, and there's increasing regulatory pressures which are increasing costs, and so you've got over time it could be a real shrinking of that profit that there's been in the past.
Is there anything that we haven't touched upon that you think is really important for our listeners to know, or anything that you've mentioned already that just bears reemphasizing?
Well, it's a fair question. My goal is not to create alarm bells for those that are already in the industry doing AUM or doing retainer. And it's not to say you're not adding value. I think you are. Anybody who's in true financial planning and providing financial planning services are a true value add to their clients. I think the issue that we kind of ended on, Bob, was the fact that when you disconnect the price to what is the true value of the relationship, that can create a problem in the long run, because then the client, again, is seeing the price connected to the non-value component, and it devalues, as you said, what is truly valuable. And that would be, I think some firms are starting to better price in and create a pricing mechanism to more attach it to the planning. And that would be, I think for your listeners, that would be my suggestion. Then as it relates to hourly, it's not the easy road, but I will tell you, it is so fulfilling. We love what we do. We love our clients. We feel privileged every day to do what we do, and it's worth a shot. But if you're going to do it 100%.
All right, Mark, I've had such a great time chatting with you. I hope our listeners feel the same after they listen to this podcast, and with hope you'll come back on again in the future, and I'll get to ask you all the questions I didn't ask.
That'd be my pleasure. Thanks, Bob.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments in Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsinwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsinwealth.org.